Hey, what's up everyone, and welcome to the School of Personal Finance, where my mission is to help you become great with money. So we're going to start talking about investments. This is going to be the first video in a series that I'm going to put together on all different types of investments in different asset classes. In this first video, I'm going to go over the basics. I'm going to go over some mindset type of stuff, the reasons why we invest. I'm going to show you some cool rules and calculations, and I'm also going to take you into my financial calculator and show you how I mess around a little bit to try to project how much money I'm going to have in retirement, or to calculate payments on mortgages, all that fun stuff. So let's go ahead and get started. So why do people invest? And do we really need to invest? And the quick answer is yes, everybody needs to invest. It's not easy to figure out what you should be investing in and how you should invest, but the key here is that everybody needs to invest. When I used to work in the bank, I had a lot of clients, older clients that would come in and they would be scared to death of taking any risk. So they'd always be fighting for, an extra 10 basis points on a savings account or a CD. And the sad thing was they were never getting anywhere. Inflation would eat away at whatever rate of return the CDs or the savings account were getting them. And the truth is, if you invest, if you take some additional risk, you could get such a higher rate of return over the long term, and it can make a tremendous difference in your life. So the first thing you need to wrap your head around is that you need to be an investor. That doesn't mean you have to be a stock market investor, even though that should be a piece of everybody's investment portfolio. But you just have to be an investor in general. You always have to be looking for ways to make your money grow. And the more that you could make it grow, the better your life is going to be. The three main reasons that people invest are for safety, for growth, or for income. So safety is when you need to just park your money somewhere for an emergency fund, or if you're going to be buying a house in the next 5 years and you just want it to be safe and secure, knowing that that money is going to be used in the next few years and you can't take any risk with it. Growth. You want to invest for growth when you have a long-term time horizon. So any money that you're investing for retirement, which is 20 plus years away, it should be invested in growth vehicles, because you could go through ups and downs in the markets and it's not going to have any impact on your life right now. If anything, it'll actually be better during the down times, because you could buy things at lower prices and eventually they will go back up. So all markets go through cycles. Real estate, stocks, everything goes through cycles. So when they go down, it's actually an opportunity. And if you're consistently adding to it, it helps you out when the market goes down. And then income. Income is great in retirement, out of retirement. Like, I love real estate because it could give you an income even before you're retired, which is awesome. But people invest for income in retirement in things like bonds and more secure investments, or dividend stocks. If you have a nice big portfolio of dividend stocks, that could give you a monthly income as well. So those are the three reasons that people invest. So to go back to risk versus return for a second. So the more risk you're willing to take, then the higher return you have the potential to make. So that doesn't necessarily make it a good investment. But if you're willing to take more risk and you're going to invest in something that over the long term has been proven, like real estate, like the stock market, then you are much better off taking that risk and investing on something where you could get a higher rate of return. So if you're young and you're investing for retirement, it makes no sense to have that money in money market accounts, in savings accounts, in CDs, in bond funds. You want to be more aggressive. You want to be in growth type investments, because you have a very long time to let that money grow. If you have a short time horizon, then you can't take the risk, right? Then you have to give up on the potential reward. You'd rather have stability and security, because you no longer have that long time horizon that will increase your probability of being able to get that higher return. Over a 5-year period, who knows what the stock market could do? It could go down 40, 50%. It's not worth the risk if you need to have that money in the short term. So risk reward is a big factor when we talk about investing. And inflation is a real thing in this world. So when you invest money in a savings account or a money market account or CDs, the downside is you're actually losing money, because the rate of return on those investments is lower than inflation. Inflation is the increase in prices year after year. And in the United States, over the last decade, it's averaged around 2%. Historically, it's averaged around 3%. So if inflation is 3% and you're getting 1% on your savings account, then you're actually losing 2% per year in purchasing power. It is not a long-term strategy to be wealthy. You have to be able to invest for growth so that you can make much more than what the cost of inflation is each and every year. And that leads to another term that you might hear, which is opportunity cost. So opportunity cost is what you're giving up by instead deciding to invest in something else. So if you decide to invest in a CD, then your opportunity cost is that you could use that money to invest in the stock market or in real estate or in something that will give it a higher rate of return. So anytime you make a decision, there's opportunity cost. So I don't know if you've ever heard of the rule of 72, but it's just a simple, cool rule that shows you how long it will take for an investment to double depending on your rate of return. So a simple example, if you could earn 10% on an investment, it'll take 7.2 years for that investment to double. So you take 72 and you divide it by the rate of return that you could get, and that gives you how many years it will take for that investment to double. So if you only earn 2% on an investment, then we take 72 divided by 2, and it'll take 36 years for that investment to double. So just think about what a tremendous difference that is, right? So if you get 10%, it takes 7.2 years for it to double. If you only get 2%, it takes 36 years for it to double. That shows what a big difference it makes, the rate of return you're able to get on your investments. And then we have compounding, which I'm sure all of you have heard of. But with compounding, it's just your money earning money. So the interest earns interest, and it just starts to snowball, and it just grows and grows and grows. And the longer that you have for that money to compound, the more powerful it becomes. All right, so let's jump in right now to my handy financial calculator that I seriously use all the time. I mean, it's very similar to a regular calculator. It just has some extra functions and some cool things so I could figure out like how much money I'm gonna have in the future some point, or how much a mortgage payment's gonna be depending on the interest rate or the amount that I borrow, or what the difference will be if I'm contributing $8,000 a year to an account as opposed to $6,000 a year. It just lets you play with all the variables. It's a lot of fun. So let's jump in and I'll show you some quick, easy calculations. So it's this little icon right here. I believe that I bought this in the App Store many, many years ago for like $5. Let's just do a very simple example. Let's say that you have 50,000 bucks in your retirement accounts, right? So now we use a negative sign because that's money that you have shelled out and put in your retirement account. So you've contributed $50,000. So that's outgoing from your pocket into your retirement account. Let's say that you have it invested in nice index funds that are low cost and you get an average rate of return of 8%. So we hit the 8, we come up here, interest rate 8%. Now let's say that you are contributing, let's say you're doing really good, you're contributing $500 per pay period. And now let's say you get paid 24 pay periods, so twice a month. So what we would do is we would hit 24, then we would hit this little orange button over here, the black and orange one, which is like a shift button. And then we hit the payment button. You see right below where it says PMT and lease, we have one payment per year. We're gonna change that to 24. We're making 24 payments a year into this retirement account or whatever the hell account we wanna say that it is. And now we're doing, what did we just say? We're doing $500 that we're putting in. So it's coming out of our pocket and going in every 2 weeks. Or twice a month. So $500 for each payment. And we want to see how much we're going to have 25 years from now. All right, so we're going to hit 25, and then we're going to go ahead and hit the shift button again and hit the end button. So you see when we hit the shift button, that means that it's going to be the number of payments times years. So we're doing 25 years, 24 payments a year. So when we hit this end button, it'll calculate it for us. That's 600 payments altogether that we're putting that $500 in. And that's everything. So now we just hit this future value button and it's going to tell us how much we'll have 25 years from now. So let's see. So 1.3 million bucks. So not too bad. So now the way that you could play around with this is you could increase or decrease the amount of your payment. You could change the interest rate. So let's say that the market's, or let's say that you're afraid of the market and you're saying, you know what, I'd rather just keep it in a nice savings account inside of my retirement account. So I'll be lucky to earn 2%. So 2% interest. So instead of having $1.3 million, you're going to have $471,000. So that is a huge difference by not taking the risk and investing in a growth type of asset. So now again, of course, the 8% is not guaranteed, but over the long term, that's what the stock market has averaged, and that 2% for the savings accounts, that's what we're looking at right now, not even that high. So this is a very realistic example. So let's say that you are a rock star and that you could make 12% per year, which is not realistic in these retirement accounts, but let's say that you did over 25 years. Instead of having that 1.3 number at 8%, you would then have just about $2.9 million. So see what a tremendous difference it makes depending on the rate of return. And this is why fees are such a big part of this. If we go back to 8%, at 8%, you're making 1.3. Let's say that you're invested in funds that have fees of 1%. So instead of making 8%, you only make 7% because of the fees. So instead of getting $1.3 million, you only get $1.1 million. So it costs you $200,000 over these 25 years having more expensive funds in your retirement account. So it makes a huge difference. And now let me just show you. I'm going to clear that out. Let's look at mortgages. So say you want to take a $250,000 mortgage. You know, we'll keep that as positive. So present value. So $250,000 is the amount of the loan I'm about to take. I'm going to have 12 payments a year. So I need to change that 24 to 12. So I'm going to hit 12, shift. There we go. So now 12 payments a year. It's going to be a 30-year mortgage. So I'm going to do 30 years, shift. That gives me 360 payments. My rate is going to be 5%. My future value is going to be 0 because when I'm done paying it off, it's 0. There's no more left. So now I hit my payment button and it tells me that my monthly payment is going to be $1,342. So now let's say interest rates go up a little bit and it's 6%. Instead of my payment being $1,342, it goes up to $1,500. So right there, I mean, that's a pretty big increase because of a 1% increase in rates. So that shows how as interest rates go up, homes become, less affordable because of the interest cost. All right, so that's all I really want to show you on there. Let me know in the comments below if you like this. I mean, I'll spend 20 minutes just going through and messing around with different things and showing you guys different stuff on here. All right, let's get back to it. And then the last thing I wanted to touch on are the different types of asset classes that people invest in. And I'm going to make a video on each type of these asset classes in this investing video series. So the first one are stock market type investments. The next one are bonds. After that, we have cash and cash equivalents, CDs, savings accounts, money market accounts. After that, we have real estate. And then finally, we have commodities. We'll get to those things in a future video, and we'll go through all the different things to look at when investing in those asset classes and what might be right for you. So that's it for this one. Hopefully you found that helpful. Make sure to hit that like button if you enjoyed this video. Hit that subscribe button if you've not subscribed to the channel yet, and I will see you again in the next video. Thanks a lot.